Okay, class, in this video, we are going to be doing the practice problems for our Learning Module 5 homework assignment. Learning Module 5, we are doing Chapter 6. In Chapter 6, we learn about how to start a merchandising business. So there's a lot of new things that we're learning in Chapter 6. So I wanted to take this chance to kind of go over some of the homework problems. So I did create the practice problems for Chapter 6, as I said I would. And so now I'm going to record a quick video, and we're going to work through these problems together. And I'm going to explain what we're doing and try and reference in the textbook where we can find the solutions for these problems as well. Okay, so really quickly, I'm going to open up my textbook as well. So just bear with me for one moment. Again, the practice problems you find, they're in Cengage. I provided a link to the practice problems in your learning resources folder for Learning Module 5, as well as the link to this video. So I'll try to remember to send out emails to remind you guys that they have in here. So the first thing we're going to talk about is the first thing we learned, one of the new things we learned about in Chapter 6, which is gross profit. So gross profit we learned about in section 1B of Chapter 6 when we started talking about financial statements. And we have a little exercise problem similar to this one. So if you want to reference how to solve this problem, you would go to example exercise 6.1 in your textbook. But here what we're doing is we're talking about gross profit. We learned that we have a new revenue account that we use name is called sales. So when merchandise is sold, the revenue is going to be reported as sales, and its cost is recognized as an expense. And this expense is going to be called cost of merchandise sold. So the cost of merchandise sold is subtracted from sales to arrive at gross profit. It's called gross profit because it's the profit before we deduct the operating expenses. So let's look at the problem. It says during the current year, merchandise is sold for 155,000 cash, 475,800 on account. The cost of the merchandise sold is 435,300. Well, we just learned that gross profit is your sales less the cost of merchandise sold. So they kind of tried to trick you in this problem because they split the sales up between cash and on account. But we've learned that when you have either a sales, a cash transaction, or an on account transaction, they're both reported to revenue. And again, sales is revenue. So we would literally add the cash sales and the on-account sales together to get our total sales. So 155,000 plus the 475,800 equals a total sales of 630,800. Then we would subtract out the total cost of merchandise sold, which was 435,300. So let's go ahead and show the answer key. So here we can see how the solution is solved. So again, you would add both of the sales, the cash sales and on the account and the on account sales together to come up with your total sales. And then you subtract out your total cost of goods sold. And this gives us our gross profit of 195,500. Okay. So let's go ahead and move on to the next problem. Now we're talking about purchase transactions. So there's a lot of different merchandising transactions that are going to be different from the transactions we've looked at before. And purchase transactions is one of them. So there's two systems for accounting for merchandise transactions. You have perpetual and periodic. In a perpetual inventory system, each purchase and sale of merchandise is going to be recorded in the inventory account and related subledger. In a periodic inventory system, the inventory does not show the amount of merchandise available for sale and the amount sold. Instead, a listing of inventory on hand called a physical inventory is prepared at the end of the accounting period. So let's look at our problem here when it's talking about when we say purchase transactions. It says that the Barron's company purchased merchandise on account from a supplier for 13,500. So we have some new terms. We see this right here. So this is a new term that we've seen. So when you purchase items on account, this means that the vendor is going to provide you with your merchandise and then bill you later for them. So you'll receive an invoice in the mail stating your payment terms and the amount due on the invoice. So these this highlighted here are your credit terms. So the 1-10 states that if you pay this invoice within 10 days of the invoice date, they will provide you with a 1% discount. If you do not pay it within 10 days, then the total amount is due within 30 days of the invoice date. So the 1/10 means you'll get a 1% discount if you pay it within 10 days. The N30 means that the full amount is due within 30 days of the invoice date. So some of you may be thinking 1% doesn't sound like a big deal, but if your total is 13,500, well, 1% is a significant amount. Yeah, you'll be saving $135. And of course, this will add up over time. So next, it's the next section. It says the Barron's company returned 2,600 of the merchandise and received a full credit. So we purchased $13,500 worth of merchandise on account with credit terms of net 30 or a 1% discount if paid within 10 days. We also see that the Barron's company returned $2,600 of the merchandise and received a full credit. So how would we solve this problem? Well, let's look what it's asking us. It says A, if Barron's company pays the invoice within the discount period, what is the amount of cash required for the payment? And then B asks us, what account is credited by the Barron's company to record the return? So let's go ahead and click on the answer key. I like to do this because it shows the math when coming up with the answers. All right, so let's look at A. All right, the return of merchandise reduces the original invoice amount to be paid. The discount is taken on the amount owed on the merchandise after the return. So let's look how we came up with $10,791. So the first thing we're going to do is go ahead and take the discount out the total. So we would take the 13,500 and multiply it by 1%, and then subtract that from the 13,500. So basically what we did, excuse me, is we subtracted $135 because 13,500 times 1% is $135. So we subtracted $135 from the total amount of 13,500 to get the discounted amount, right? Less the return of the merchandise. Now, if excuse me, we applied a discount to the total amount owed, we also have to apply the discount to the amount that we returned. So we would take, again, we would take the amount of the merchandise returned, which is $2,600, and multiply that by the discount of 1%. And subtract that from 2,600, and we get 2,574. So we would take the discounted amount of 13,365, and then subtract out the discounted amount that we returned, which totaled 2,574. And that gets us 10,791. And that is how much that Barron's company will owe for this merchandise. Now it asks what account is credited by Barron's company to record the return. Okay, well, let's think about this. If we purchased merchandise inventory is an asset account. So when we purchase inventory, we're going to debit our merchandise inventory account because, again, it's an asset. If we're going to take some of that inventory that we purchased and return it, then we no longer have this inventory on hand. All right. So we would credit our asset account merchandise inventory to show that that inventory that we had on hand, we returned. So we're reducing the amount of inventory we have on hand. Excuse me. So the next thing it wants us to do is wants us to record a sales transaction. So I'm going to go ahead and open up all the tabs. It says journalize the following merchandise transactions, and of course refer to your chart of accounts for the exact wording of the accounts. So let's look at this transactions. It says on March 1st, we sold merchandise on account, okay, for $77,100. All right, so we've moved from a purchasing transaction. We're now talking about a sales transaction. All right, so this first sales transaction is sales on account. So here we would look at section 2C of chapter 6 for sales transactions, and we would scroll down to the section for sales on account. Now we have the terms to 10%, 2% discount if paid within 10 days, or full amount due within 30 days. All right, so the cost of the merchandise that was sold, they told us was $42,750. So we have these sale amount, and then we have the cost of goods sold amount. Okay, so let's look at the next transaction. We received a payment less the discount. All right, so it says here that they paid us within 10 days. Okay, so they paid us less the discount. And then on March 13th, we issued a $2,500 credit memo for damaged merchandise. The customer agreed to keep the merchandise. So it wants us to show how we're going to journalize these entries. So let's go down here and look at the journal entries. I went ahead and had them filled out so we can kind of just start talking about them. When you go to record the sales of merchandise and you offer a discount, you are going to go ahead and you're going to enter, all right, the sale with the discount. You're going to assume your customer is going to take full advantage of the discount. So when you originally go to record that sale transaction, you're going to record it at the discount rate. So if you see here, the amount we sold them was $77,100. All right, so we went ahead and took that $77,100 and multiplied that by the 2%. All right. All right, 2% is $1,542. So I'm going to subtract that $1,542 from the total sales. And we get $75,558. So that's how we came up with the amount. So let's talk about the accounts that we used. All right, this is a sales transaction. First of all, that's your first clue, is a sales transaction. Sales is revenue. So we sold merchandise. So we're obviously going to be recording to a credit to our revenue account sales. It says we sold the merchandise on account. So we know this phrase is important. It means that we are going to bill the customer for the merchandise we sold them. So we're not receiving cash at the time of the sale. So we extended credit to our customer. And these are the credit terms that we offered our customer. Okay. So again, if you offer a discount to your customer, when you go to initially record your sales transaction, you're going to go ahead and take full advantage of that discount and record your sales at the discounted rate. So that's exactly what we see here. So we debit our accounts receivable. We're setting up the receivable for our customer, showing that that customer now owes us $75,558. We've already provided the merchandise. So the sales transaction is complete. So we can record the entry to our revenue sales account. So we see here our credit to our sales account for $75,558. Now, let's go back up to the top. It told us that the cost of the merchandise sold was $42,750. So we know whenever we do have a sales transaction for merchandise, that it's a four-sided entry. We start with our asset account, right? Start with our asset account, either accounts receivable or cash. This one was on account, so it's accounts receivable. We credit the revenue account sales, but we also have to update our cost of goods sold and our merchandise inventory. All right. So it told us that our cost of merchandise sold was $42,750. Cost of merchandise sold is an expense account, so we are going to debit the cost of merchandise sold for the $42,750. We also have to update our inventory. So we just sold that inventory, so we no longer have that inventory on hand. So we now need to reduce our merchandise inventory account. And merchandise inventory is a, asset account. So to reduce an asset account, we are going to credit the account. So on March 1st, to record the sales transaction is a four-sided entry. We sold the merchandise on account at a discount. So we see the discounted amount is recorded. We debit accounts receivable. We credited our revenue sales account. We debited our expense account, cost of merchandise sold. And then credited our merchandise inventory account, reducing our inventory on hand. So let's go back up here to 9. It says they received payment less the discount. So they went ahead, they did take advantage of the discount. They paid us within 10 days. So if you see here, the transaction was on March 1st. We received payment by March 9th. So that's well within the 10 days. So to record the payment, we received the payment. So we know we're going to be recording cash. We received cash, therefore we're increasing our cash. And to increase our cash is a debit entry to our cash account. So we see here a debit entry to our cash account for the discounted rate, which we had already recorded up here. Now, because we did set up a receivable for them, all right, we're going to have to now reduce the receivable. So we originally debited accounts receivable. So now that the customer has come in and paid what they owed us, we're going to now credit accounts receivable. So it's because it's no longer a receivable. Customers paid it. So we're going to close out that receivable and by doing a credit to the receivable account for the amount. Okay, so that's all we would do for for number 9, for date March 9th, excuse me. Next, it says we issued a $2,500 credit memo for the damaged merchandise, and the customer agreed to keep the merchandise. So let's talk about what happens down here. So we do know that we generate a customer refund payable. We set that payable up usually at the end of the fiscal year. We set up the payable and we offset any refunds, okay, against that payable. Right. We also are going to offset because the customer agreed, okay, to keep the merchandise. So instead of giving them a cash refund, let's go back up here. We issued what's called a credit memo. Okay, a credit memo. So we didn't do a cash refund. All right, we offered a credit. Now, why would we do that? Let's talk about credit memos and what they mean. All right. Most of the time, your customers are repeat customers, and your customers are probably having constant revolving credit with you, to where they may actually have multiple invoices open and outstanding with you. So they may choose, instead of getting a cash refund for the return, ask, hey, can you just credit our account with you? And so that's obviously a more favorable option because it doesn't reduce your cash. Okay, it just reduces your receivable. So when you offer a return and it's is issued in the form of a credit memo, in other words, not a cash refund, but a credit memo, then what you do is you credit the accounts receivable, and you would see then that credit on their subledger for accounts receivable, showing that that credit was issued specifically to that customer's account. Okay, so let's move on to the next problem. Okay, so this is the same problem. So we'll just quickly click on the answer key to kind of show you the answers and the math involved. Okay, so the first, I want you to journalize these merchandising transactions. These are all sales transactions. So we sold merchandise on account for $19,100 with credit terms of 1% discount if paid within 10 days or full amount due within 30 days. The cost of the merchandise sold was $11,460. All right, so we know our sales transactions are four-sided entries. So we're going to start with a debit to accounts receivable because we sold the merchandise on account. Okay. And we're going to go ahead and credit our sales account. Now, because we offer a discount, we're going to go ahead and calculate that discounted rate. So right down here, we can see the formula for how to calculate that discounted rate. You take the amount of the merchandise sold, the sale amount, multiply it by the 1%, and then subtract that from the total sales amount. And that the discounted amount is now $18,909. So that is the amount that we're going to record for this transaction. Now, the second half of this transaction is to record the cost of the merchandise sold. And it told us that the cost of the merchandise that was sold was $11,460. So we're going to debit our cost of merchandise sold expense account, showing the amount of merchandise that was sold, expensing it out. And then we're going to credit our merchandise inventory account, reducing our inventory on hand because it's been sold. All right, so now let's look at B. We received cash payment less the discount. So again, we're going to show a debit to cash because we received cash. We increased our cash, and that means a debit. And they paid it less the discount amount. So the amount that we calculated up here is the same amount we'll use here. And then, of course, we're going to close out that receivable because they've paid it in full. So we're going to credit accounts receivable, reducing that accounts receivable balance. All right. Now let's see. C says issued a refund. All right, but instead of a cash refund, we issued a refund in the terms of a credit memo. Okay, for a credit memo. So again, we know we're going to reduce our customer refund payable that we set up. So we're going to debit that payable account. And then because we issued a credit memo, okay, we're going to credit it to their account with us. So we're going to credit accounts receivable. And specifically, it will show up on the accounts receivable subledger, specifically for that customer, showing that they returned the merchandise and we offered them a credit on their account in the form of a credit memo. All right. So let's look at the next problem. Now we're talking about freight terms. Freight terms you can find in your textbook in section 2D of chapter 6, where we talk about different how purchases and sales of merchandise often involve freight. And the terms of a sale indicate when ownership, which is title and control of the merchandise, passes from the seller to the buyer. All right, so this point determines whether the buyer or the seller pays the freight cost. So let's talk about this. Let's look at this problem. It says determine the amount to be paid in full settlement of two invoices A and B, assuming that credit for returns and allowances were received prior to payment, and that all invoices were paid within the discount period. All right. So A, okay, we have free on board shipping point. And B, we have free on board destination. All right, so those are going to be calculated a little differently. All right, so let's go ahead and show the answer because I like to be able to show you guys the formulas so that you know how to calculate and come up with the answers. So the merchandise was $5,250. Freight paid by seller, all right, $200. The freight terms were free on board shipping point. And then the credit for refunds and allowances equaled $1,250. So let's look at A. Now, under FOB shipping point, really quickly, freight is paid by the buyer, while under FOB destination, freight is the seller's expense. So determine the amount. So we need to determine the amount. First, deduct the return before calculating the discount, then calculate the purchase minus return minus discount plus applicable freight. So let's look at A, okay? So we have a purchase, all right, of $5,154. So how do we get this amount? So of course, we're gonna apply the discount. So remember the terms here, what they mean. So this is a 2% discount, okay? But, if paid within 10 days, so we're going to apply that discount. So we're going to take 2% of the merchandise total of $5,250. And that equals $5,154. All right. Next, we're going to take the credit for refunds and allowances. And because we applied the discount to the merchandise, we're going to apply the discount to the returns. All right. So once we apply the 2% discount to the returns, we now have a return total of $1,225. So we will take the purchase of $5,145 minus the return of $1,225 and then add $200 of shipping. So for A, the amount to be paid in full for invoice A equals $4,120. Now let's look at B. All right, so B is going to be a little different because we have FOB destination. All right, so just like with A, we are going to go ahead and apply the discount. So we see the discount terms here, 1% if paid within 10 days. So we're going to take our merchandise, total of $3,900, and we're going to apply the 1% and subtract it out. So we have a purchase of $3,861. But we also have a credit for refunds of $900. So again, if you apply the discount to the merchandise total, you have to apply the discount to the return total. Okay, so 1% of $900. All right, minus and then subtract out from the 900 equals a return of $891. Now, because it is FOB destination, we do not add the shipping. We do not add the shipping. So you would just take the purchase of $3,861 minus the return of $891. And the amount to be paid in full for B is $2,970. All right. So now let's talk about some transactions for a buyer and seller. So instructions tell us that on March 1st, Sally Company sold merchandise to Buck Company on account for $28,400 with credit terms. All right, so let's look at the credit terms. So first, let's look at the credit terms. So they're offering a 2% discount if paid within 15 days. Okay, so this means a 2% discount if paid within 15 days or full amount due within 30 days of the invoice. It also lets us know that the cost of the merchandise sold is $19,500. And then it says the merchandise was paid for on March 14th. Assume all discounts are taken. So we have to journalize the entries for Sally Company and Beck Company for the sale, purchase, and payment of the amount due. All right, and of course, you always want to refer to your chart of accounts. And again, when we I do this part, I go ahead and show the answer key because I am trying to save time, but we know the trick of instead of trying to remember exactly how the accounts are worded, when we go to put the accounts in the journal entry, remember I showed you the trick to where you can come in here and highlight it and do a copy and paste. So if you do a copy and paste of the accounts from when you plug them in, that really saves a lot of time, So let's go down here. So we have the chart of accounts for Sally Company. You have the chart of accounts for Buck Company because you're recording the purchase transaction and the sales transaction, okay? All right, so let's look at this. So on March 1st, so we're going to do the journal entry for Sally Company first. So journalize the entries for Sally Company for the sale on March 1st and the payment of the discount due on March 14th. Okay, so let's go back up to see what happened. Now on March 1st, it says Sally Company sold merchandise to Buck Company. All right. They sold it to Buck Company on account for $28,400 less the discount. Okay, so let's go down here. All right, and I'm going to go ahead and show this really quickly. All right, how to calculate the discount. So again, you'll take the total sale amount of $28,400 and multiply it by the 2% discount. And then you'll subtract that out again from the total amount of the sales transaction. So your discounted amount for the sale is $27,832. Again, if you are offering a discount to your customer, you are going to initially record your sales transaction, assuming all discounts were taken advantage of. Okay, so let's go up here and look at our March 1st transaction. So we're going to see that we are going to debit the accounts receivable for Buck Company. All right, because we're setting up the receivable. We're setting up the receivable. All right, and so we're going to debit accounts receivable for the customer Buck Company for the discounted amount of $27,832. And it is a sales transaction. So we're going to go ahead and record the revenue to our sales account for the discounted amount of $27,832. But we know every sales transaction is a four-sided entry. All right, so we also have to hit our cost of merchandise sold account. It told us that the cost of the merchandise that was sold on March 1st was $19,500. So we're going to go ahead and debit our expense account, cost of merchandise sold for $19,500. And then we're going to credit our merchandise inventory account because we're reducing the amount of inventory we have on hand. So we see a credit to our asset account, which is merchandise inventory for $19,500. And now it said that the payment, we received payment from Buck Company on March 14th. So if the credit terms were 2% discount and paid within 15 days, and we received payment on March 14th, then we received it within the 15 days. So we will increase our cash account to show that we received payment for the amount of $27,832, which is the discounted amount. And then we're going to go ahead and close out their receivable for Buck Company because they no longer owe us that money. So we're going to credit accounts receivable, the $27,832 because we're closing it out. All right, Buck Company no longer owes that money, so we're going to close out that receivable. All right, so now let's talk about the journal entry for Buck Company. Now, Buck Company is the purchase transaction. So Sally Company would be the sales transaction, and Buck Company would be the purchase transaction. So we're looking at both sides. We're looking at the company that made the sales transaction, and we're looking at the company that made the purchase transaction. Okay, so what would be the journal entries on Buck Co.'s side of the house? So they made the purchase. So we would see on March 1st, they purchased inventory from Sally Company on account. All right, so when we make a purchase on account, we've created a liability, right? Right. And then what did we purchase? We purchased our merchandise inventory. So on March 1st, we're going to see a debit to Buck Co.'s merchandise inventory, totaling $27,832, again, because we took advantage of that discount. Okay. And we went ahead and set up a payable for Sally Company, our vendor, showing that we owe Sally Company money. Specifically, we owe them $27,832. All right. So now we've paid Sally Company, and we paid them within the 15 days because we paid them on March 14th. So that's within 15 days. So we can pay, we only owe them the discounted amount. So we see a debit to our payable. Because we're closing it out. We're closing out our payable for Sally Company because we paid the invoice. So we no longer owe Sally Company the money. And then we're going to credit our cash account because we've paid our bill. We paid the bill. So we're going to reduce our cash on hand. And that's it. That's it for that transaction. Okay. All right. So again, this is a similar situation, and just a different view, kind of a more practice. But again, so we have the transaction for we have the sales transaction, and then we have the purchase transaction. So we have LA Company sold merchandise to Chain Company on account. The total amount of the merchandise sold was $154,700. Now we have something new here. We have terms of FOB shipping point. Okay, freight terms in which the buyer pays the transportation costs from the shipping point to the final destination. So we'll be adding that in. And then we have the discount and the credit terms. 2% discount if paid within 10 days, our full amount due within 30. It provides us with the cost of the merchandise sold, which equals $92,820. And it says that Ellis Company paid freight of $2,800. All right. And it tells us to assume that all discounts are taken. So let's go ahead and look at how we calculated this amount for A. So the total amount of merchandise that was sold equaled $154,700. So immediately we're going to take that 2% discount. Okay, immediately we're going to take that 2% discount. So this amount is the $154,700 less the 2% discount. Okay. All right. So we're going to debit our accounts receivable for chain company, and we're going to credit our revenue account sales to show that this is a completed sales transaction. We're also going to update our cost of merchandise sold, and it told us that the cost of merchandise sold was $32,820. So we're going to record that to our expense account, cost of merchandise sold, and then we're going to reduce our inventory on hand by crediting our merchandise inventory account because we've sold that inventory. We no longer have it on hand. So we got to reduce that account. Next, we're going to show that the receivable for the freight. So we're going to increase the accounts receivable to Chain Co. for the $2,800, showing they owe us the $2,800. And then we're going to show that we went ahead and paid it. Now we paid it. Okay, we paid the shipping. But we are going to pass that cost on to Chain Company because it's going to be part of the invoice that we send to Chain Company. So even though we did pay the freight, all right, it is not an expense for us because, all right, it's FOB shipping point. The buyer pays the transportation costs. Okay, the buyer. All right, so normally how this is set up, and I mean, a lot of us have dealt with this when we go to purchase things online, it usually calculates the shipping. So what happens is the seller, when you pays for the freight and then bills you for it. So you have to like reimburse the seller for it. So that's what we're setting up right here in B. That's exactly. So it shows that we paid it because we reduced our cash for the $2,800, but we're not expensing it. We're passing the expense on to Chain Company. So we're increasing the receivable for Chain Company for the freight because they owe us that money. And then the last transaction is to show the total amount paid to us from Chain Company. So C, it shows the payment of the amount due right here. So A is the sales transaction. B is to show where we paid the shipping. And then C is to show the payment from Chain Company. All right. So again, how do we come up with this amount? Okay, it's simple. We take the total amount of the merchandise less the discount plus the shipping. And we can see that down here, right here. So total amount of the merchandise less the discount plus the shipping. And that is the total amount that Chain Company owed us. So we see we went ahead and closed out the receivable because the Chain Company paid us the discount, paid us the full amount less the discount and plus the shipping. And then, of course, we're going to debit cash. Now let's look at the transactions for Chain Company. Now they're the ones that made the purchase. So what would their entries look like for making the purchase? So they're going to go ahead now. You see here really quickly, this amount, okay? This amount looks familiar. It's this amount. It's the amount of the merchandise less the discount plus the shipping, okay? When the buyer pays shipping, shipping becomes part of the cost of the merchandise, okay? Chain Company is going to record the cost of their merchandise at that amount right here, this amount. You see it right here. So it's the cost of the merchandise less the discount plus the shipping, okay? So we see here that they go ahead and they increase their inventory for the purchase. And they went ahead and set up a payable showing they owe the money to Ellis Company. So because we see a credit to our payable accounts payable subledger Ellis Company. Now B, we're to record the transaction showing the payment. Okay. And we are assuming that all discounts were used. So here, we take it out of accounts payable. We basically close it out because we are paying our bill. So we no longer owe the money to Ellis Company because we're paying it. And then we reduce our cash showing that the bill has been paid. All right, so let's move on to the next. All right, this is an account talking about inventory shrinkage. It says Novelty Furnishings Company uses perpetual inventory records, indicates that $713,650 of merchandise should be on hand November 30th. The physical inventory indicates that $702,450 of merchandise is actually on hand. So it wants to journalize the adjusting entry of the inventory shrinkage. Okay, so let's go ahead and look down here. So of course we would always take advantage of the chart of accounts. And again, I encourage you, copy and paste. So you would copy it and then paste it down here. All right. So you don't have to worry about trying to type it just right. All right. So what would be the journal entry? So when you have inventory shrinkage, you are basically going to expense out the shortage to your cost of merchandise sold account. All right. Now, let me show you the math really quickly. So this is what the perpetual inventory system said we should have on hand. And this is what we physically had on hand. And the difference is 11,200. So that's where this amount came from. All right. So when you are recording inventory shrinkage for a perpetual inventory system, the amount of the shrinkage is expensed to your cost of merchandise sold account. And then it is used to reduce your merchandise inventory account. Because what's happening right now is, according to your inventory system, your ledger states that your inventory balance is $713,650. You went ahead and did a physical count of your inventory and saw that it was only $702,450. Okay, so you have to now get your ledger to match what you physically have. So that's what we're going to credit your merchandise inventory account. So you're reducing this balance right here. I'm sorry. You're reducing this balance right here. So it will reflect this balance, the balance you actually physically have on hand. Okay. So that is it for that problem. So let's move on. This is the same problem. So just go ahead and click on the answer key. So again, it's talking about inventory shrinkage for a perpetual inventory system. So it says that the records, meaning your ledger, okay, your account balance on your ledger states that your inventory balance is $259,790. You did a physical inventory and it showed that the physical inventory resulted in a merchandise balance of only $233,810. So we need to do a journal entry for the shrinkage. So again, you're going to do the math, and it's basically taking what your ledger says less what you physically have. So we have a total of $25,980 of inventory shrinkage. So what we're going to do with it, we expense it out to our cost of merchandise sold account. So we expense it out, and then we have to reduce our merchandise inventory so that our book total now matches what we physically have. So this is our book total as of right now. So if we credit our merchandise inventory account $25,980, we're going to reduce our book total, or was on our ledger. So now it will match what we physically have. Okay, let's move on to the next problem. All right, now it's talking about the customer refunds and allowances. It says to assume the following data for Casper Company before its year-end adjustments. So your total sales for the year is $1,750,000. Estimated percent of refunds for the year is 0.6%. It says to journalize the adjusting entry for customer refunds and allowances. So I'm going to go ahead and click on this because I like to show the math. So it's simple. You take your total sales for the year, multiply it by your estimated percent of refunds. Now, it's 6%. Okay, 0.6%. All right, so we have to change that 0.6% to a decimal so that we can multiply it. So when you do that, you actually move the decimal point 2 places to the left. So we see that right here. Okay. So here is represented as a percentage. Here is now represented as a decimal. Okay. So you would just take that amount and multiply it by your total sales. So the amount for your customer refunds and allowances is going to be $10,500. So how do we journalize this? Okay, so what we're going to do is we're going to reduce our revenue sales account, and we're going to create a customer refund payable. And then that customer refund payable, okay, will be used in the next fiscal year, and every refund and this issued will be used to reduce that payable. Okay, so we're setting up the payable at the end of the year. So we start out by debiting our sales account because we're going to reduce our revenue by the amount of the estimated returns. And then we're going to set up our customer refund payable by crediting the payable account. And again, and then in the following fiscal year, every refund that's issued, it will result in a debit to this payable account, reducing this balance down. And then the debit will be to the payable, and then the credit will either be your cash, if it was a cash refund, or it'll be against accounts receivable if the refund was issued as a credit memo. All right, so let's move on to the next problem. All right, so we are now into our financial analysis. So we're talking about asset turnover. All right, and I'm not been keeping up with the sections in your book. I apologize for that. But the financial analysis is section 5. And here we're talking about asset turnover. And this is sometimes called the ratio of sales to assets. And it measures how effectively a business is using its assets to generate sales. A high ratio indicates an effective use of your assets. So asset turnover is calculated by taking your total sales and dividing it by your total average assets. Okay, so let's look at the problem here. We have 2 years, all right, and they provided us with the total sales. But we have to do math before we even start to calculate the ratio. We have to calculate our total average assets. How do we do that? We'll take the beginning year total, add it to the end of the year total, and then divide it by 2. So you would take 410,000 plus 530,000 and then divide it by 2. And you do the same thing for the other year. You would take the 530,000, add it to the 740,000 and divide it by 2. And that gives you your average total assets. All right, so let's go ahead and show that. So the first thing I want you to see here, this right here, all right, is what I was talking about. So we're looking at year 3, all right. All right, so for year 3, we take the beginning year right here, add it to the end of the year total of assets, and then divide it by 2. All right, so I'll do that math really quickly, excuse me. Try that again. All right, so your average here, based on this math, your average total assets is 635,000. You would take 635,000 and you would divide it into your total sales of $1,206,500. All right, so for year 3, your asset turnover then is 1.9. So again, you take this amount, add it to this amount, and then divide that the sum by 2. That sum is then divided into your total sales. All right, so once you divide that into your total sales, you should get your asset turnover ratio, and we see a ratio of 1.9. So let's go ahead and do that same thing for year 2. So year 2, we start by taking our beginning of the year balance, adding it to our end of year balance, and dividing it by 2. So we see that calculation right here. So we have the 410,000 plus the 530,000. divided by 2. So your total average assets for year 2 equals 470,000. We would take 470,000 and divide that into your total sales of 799,000. And we have an asset turnover of 1.7. So B asks, is the change in the asset turnover from year 2 to year 3 favorable and unfavorable? Well, it says a high ratio indicates an effective use of assets. So the higher the ratio, the better. So from year 2, we went from 1.7 to 1.9 in year 3. So that would be a favorable change. Okay. So I'm going to stop there. Really quickly, I added a few more problems. I'm going to stop my video here. These are just extra problems. They're not problems that are on your homework, but they would be very helpful problems for practice. So I'm going to see if anybody wants to tackle these problems. Let me know if you want to tackle these problems. But I just threw them in there. Just as, if you want to test yourself to see how well you're understanding the material in this chapter. These are probably problems we will do in class together. So I'm not going to put them on this video. But again, I encourage you guys, if you are working your practice problems and you get stumped, or you're working your homework problems and you get stumped, you're always welcome to email me and I'll be glad to walk you through the process to solve the problem. So I hope you guys have a great week, and I will be talking at you later.